In this segment, we will look at the application of debits and credits in the transaction analysis, recording transactions, and posting. If you have not yet created a little cheat sheet, hard copy document that details the different account normal balances and how they are increased or decreased, I highly recommend you do so. It will make following this discussion much simpler. Let's take a look at some common business transactions and how they are analyzed and recorded. Let's assume that a shareholder invested $30,000 in ABC Company on December 1st. We need to tell the accounting system that this transaction occurred and change the accounts that were affected. First step is to analyze what accounts were affected. The company received cash, increasing their cash, and it also issued stock, increasing the common stock. So we need to increase common stock and increase cash. Let's prepare a journal entry to do so. To increase cash, we will debit it in the amount of $30,000. To increase common stock, we will credit it $30,000. Here is a properly formatted journal entry. The account being debited is first. The account being credited follows, indented. The total dollar amount of debits equal the total dollar amount of credits. We have at least one account debited and at least one account credited. This journal entry in the general journal is just telling the accounting system what accounts need to be changed. To actually cause the account to change, we need to take each debit and credit and post it to the general ledger. So let's start with the debits. We are going to take a $30,000 debit, go to the general ledger, find the cash account, which is account number 101, and post a debit to it. That debit will increase the cash account. That debit will increase the cash account. To put our post reference, we will take account 101 back to the post reference column in the general journal, notating that that debit has been posted to the general ledger. Then we will go to the next line item, which is common stock, needs to be credited. So we will go to the common stock account, post a credit of $30,000, increasing that account balance. The account number would be posted back in the post reference column. Next transaction. The company purchased supplies and paid $2,500 in cash. We know that cash is going down. We need to decrease cash. Supplies are going up because the company bought more supplies. Both of these are assets. We need to decrease cash, increase supplies. To increase an asset, we debit. So we are going to debit supplies, $2,500. We are going to decrease cash with a credit of $2,500. Properly formatted journal entry. Account being debited first, followed by the account being credited, indented. At least one account is debited. At least one account is credited. Total dollar amount of debits equal total dollar amount of credits. Journal entry in the general journal now needs to be posted to the general ledger to actually cause the account balances to change. So we would debit supplies, increasing its account balance by $2,500. We would credit cash, which would decrease that account balance. Bring the account number post references back to the general journal and put them in the post reference column. Next transaction. ABC purchases equipment, paying $26,000 in cash. The company's cash needs to decrease and equipment needs to increase. Let's prepare the journal entry in the general journal. To increase the equipment asset account, we debit it. To decrease cash, we credit it. Properly formatted journal entry. Debits first, followed by credits indented. At least one account debited, at least one account credited. The debits equal the credits. To cause the account balances to change, we post them to the ledger. Debit the equipment account, increasing it. Credit the cash account, decreasing it. Put our post references back into the general journal. ABC purchases $7,100 of supplies on credit. Supplies, asset needs to increase. Liabilities need to increase. In the general journal, we prepare a journal entry. Debit the supplies account, increasing. Credit the accounts payable, to increase. Debits first, then credits. At least one debit, at least one credit. Total dollar amount of debits equal total dollar amount of credits. Post these to the general ledger to actually cause the account balances to change and bring our post reference back to the general journal. ABC provides $4,200 of consulting services to the client and is immediately paid $4,200 in cash. Assets are increasing, cash is increasing, equity is increasing, revenues have been earned. Revenues are recorded as soon as they are earned. We are going to debit cash to increase it, and to record an increase to a revenue account, we credit it. Debits first, then credits, at least one account debited, at least one account credited. Debits equal credits. Those are then posted to the general ledger, causing the account balances to change, and the post-reference account numbers are brought back to the general journal. We would continue doing this throughout the accounting period. When we get to the end of the accounting period, we would find an ending balance, which reflects a summary of increases and decreases to all of the accounts. To ensure that the overall accounting system is in balance, in other words, our assets equal our liabilities plus our equity, we would prepare what's called a trial balance. And a trial balance is simply all of the account balances from all of the accounts in the general ledger. Accounts with debit balances are listed in the debit column. Accounts with credit balances are listed in the credit column. We add up all of the account debit balances, add up all the account credit balances. If our books are in balance, the total debit balances will equal the total credit balances, and our system is in balance. It doesn't mean we didn't make an error. We could have still made an error. This just indicates that the system is in balance.